Hello and good morning, everybody. I welcome all of you to the keynote address of our 8th Investors Conference today morning. Keynote address today will be given by Mr. Ramesh Mantri. Ramesh is a Director Investments at White Oak Capital and a well-known face in our industry. White Oak Capital itself is an avid observer and investor in consumer technology and fintech space amongst very wide variety of investments that they do. Ramesh has 17 years of experience in investing and financial analysis across sectors. Ramesh founded Ashoka Capital Advisors that advised funds and family offices on equity investments in South Asia. Earlier, he was part of the two-member team which invested in South Asia in equities and debt of Eldon Global Capital, a US-based hedge fund for over 7 years. Prior to this, he was an analyst at CRISIL, which is owned by Standard & Poor's, and India is one of the topmost rating agencies. Ramesh is a CFA charter holder, MBA from Faculty of Management Studies, Delhi, and a chartered accountant. Today, Ramesh will be talking about consumer tech and fintech businesses in India, opportunities and challenges. Post his presentation, he'll be taking the questions from the audience, and you can put your questions in the chat box. And post that, we will take it up with Ramesh. Thank you, and over to you, Ramesh.
Thank you, Vinay, and thank you, Edelweiss, for hosting us for this event and giving us the opportunity to present our views. Good morning to all the participants. We're talking today about consumer tech and fintech. We were supposed to talk about opportunities and challenges, but a lot of challenges are related to valuation, so it's more about opportunities and valuations. So we'll dwell into that in detail. The first question that emerges is, why are we talking about this? And the two reasons why we should be talking about consumer tech and fintech. One is the fact that as we have seen in US markets 20 years ago and China a decade ago, these businesses came on the horizon and have rapidly scaled up. And today in all these markets, they are 20 to 25% of the index. It's a larger share in the US markets. So it's more kind of given that in a decade's time, 20 to 25% of the Indian market, public markets would be accounted for these new age business models coming from consumer tech, fintech across the board. Number two, even if you choose not to invest in these sectors, because of the rapid pace at which technology is disrupting existing businesses, a number of these companies are likely to disrupt your existing portfolio companies. For example, will someone like e-grocery or Nykaa disrupt the FMCG consumer staple company? The answer is probably yes. And for example, will some of those emerging fintechs impact the profit pool of the existing banks, insurance companies? Possibly yes. So it is very important to understand what these companies and their business models and what the opportunity is. This is a space that is very early stage of evolution that started in 10 years back in China, has rapidly scaled up, and we are in the early years of that journey. And we have already seen a large number of leaders emerge in various parts of the tech bucket, whether e-commerce, food tech, health tech, ed tech, OTT gaming, or fintech. On the other side, we also have enablers in the businesses, people who enable these businesses, whether delivery companies like Delivery, Dunzo, Loadshare, financial services, payments enablers like Razorpay, or even accounting services like Khatabook. So there is an opportunity on both enablers and the underlying businesses to invest in this space. So what is the opportunity like? When you think of the opportunity, when you look at 137 crore people, the key number to focus is online transactors, which is just about 12% of the population, about 16 crore. That is likely to go to 50 crores in the next 5 years. So there is a rapid escalation between number of users. And on top of that, usage is rapidly growing. And if you think about just even in the financial services side, when we look at the number of mutual fund folios or NSE active accounts or the credit cards, we have a significantly underpenetrated financial system. So the opportunity is large and growing. What are the enablers of this thing? This evolution, rapid evolution. First is the fact that when you think about the e-commerce, when a lot of people, when you think about e-commerce, they tend to benchmark Indian companies with US and developed companies. But actually, the real benchmark is towards the East in China, because India's economic structure is more akin to China than the Western world, which is like often 50 years ahead of India. For example, India is one country where labor is cheap and real estate is expensive relative to labor. Unlike the Western world where real estate is cheap in relation to labor. And the e-commerce business model, which is effectively avoiding the usage of prime real estate and using more labor, is more akin to, useful to the Indian perspective. So fundamentally, the online businesses and the delivery-based businesses are short real estate and long labor, which is the fundamental construct with the Indian economic structure is. And the same structure is in China. China started this e-commerce journey much later than US, and today has penetration of e-commerce in the 30s versus 18% for the US market, and India is still at a single digit. So if you want to look at examples, look at China for inspiration of what's possible in India rather than looking at US. Number two, this sector is able to pass on the affordability, the customer experience. The important thing about e-commerce is they're able to deliver an unlimited aisle. One of the big challenges in India is just the availability of products in a lot of parts of the country. For example, for platforms like Nykaa or even Myntra and all, 60 to 70% of the revenues are coming from tier 2 cities. So it's an availability issue fundamentally rather than just pricing. Number two, these companies deliver extreme, great customer experience in terms of huge amount of product choice and also the ability to easily return the products, which expands the market. There is convenience that's offered by new tech. Imagine trying to book tickets earlier at the railway station versus today on the online platforms. There is speed. And of course, there are other factors like personalization that happens because of these platforms. They exactly know what you need to buy. That's why they make the right product recommendations. And finally, social validation. When we get to see that other people like this product, we are more likely to buy that product. So we get good product reviews. And of course, there's social commerce where we actually get to see what our friends are buying and what our friend reviews are. And we are likely to trust them more. And again, social commerce in India is at a very early stage of evolution. It has significantly scaled up in markets like China, which has been an innovator on the social commerce side. So clearly there are multiple disruption planks for this new age businesses. What are the key drivers of consumer tech in India? Of course, one is young demographics with an average age of 29. Younger people are just more easier to adopt technology. Even in China, the average age is today 36. So India is a much younger country. The fact that we have seen explosion in mobile internet and the world's cheapest data because of the disruption caused by geo. And then of course, there is a frictionless payments platform that I'll talk about and logistic that I'll talk about later in the presentation. But large number of enablers for rapid growth are in place. Jack Ma was once asked, what are the key ingredients of success or scale up of e-commerce business? And he said fundamentally three things. One is cheap data. Number two, frictionless payments and a good logistic infrastructure. And we'll talk about where India stands on these parameters on consumer tech currently. What are the key emerging trends we are seeing in a lot of these businesses? There's rapid increase in activity in tier 2 and tier 3 cities. As I said, it's also an availability issue. SMEs are adopting a lot of these online channels, particularly selling on Facebook shops or on digital payments. You are seeing consolidation and verticalization of a lot of categories. Leaders are emerging in a lot of consumer categories in India. You are seeing a rapid formalization of labor force in India where drivers, carpenters, beauticians, delivery partners today get paid online. And finally, we are seeing the early stage of evolution of direct-to-consumer brands in India with the likes of Lenskart, Mamaearth, Wow, and Boat. And one of the interesting thing is that because of the pandemic, the digital adoption has been accelerated by 3 years and by 4 years in Asia Pacific. That is, see, if something that was supposed to happen in 4 years happens in 1 year, that's a massive acceleration. That is why this year in 2021, we've seen a large number of unicorns emerge. Logically, those should have happened over a 4 year period because digital adoption has been so rapidly accelerated by the pandemic. You're seeing a large number of unicorns emerge in a short while. What should have happened normally in 4 years is happening in 1 year in India. That's one of the big reasons why a lot of unicorns have emerged this year. There are other factors that I'll talk about later. And moving on to the fintech opportunity. Fintech, obviously, India created the world's most best-in-class payments infrastructure. Today, our daily UPI volumes are 80% higher than China. So India has created the world's best innovation on payments. What we have created on the whole jam stack, particularly by UPI, is an innovation that the world is going to learn and pick up from. It's a global case study. The world wants to understand what the brilliant innovation India has done on payments, and the trinity of basically the Jan Dhan mobile accounts, mobile phones, and the Aadhaar has facilitated creating India the world's best payments infrastructure now, and rapid adoption of digital payments in India. And that itself is an enabler to a lot of new age businesses that we'll talk about later. Finally, coming on to the logistic infrastructure. Logistics is where India still lags, and we are still in early stages of development. And unlike the US, when Walmart started, they had FedEx and UPS and the US Post. India, unfortunately, didn't have that capable delivery partners. So companies like Flipkart and Amazon had to build their entire own delivery infrastructure. And even companies like Udaan have done their own B2B. However, now you're seeing a number of specialist delivery partners emerge with the companies like Delivery, Ecom Express, LoadShare, Dunzo, solving long distance and hyperlocal delivery solutions. So the delivery problem is getting solved rapidly in India, and with more capital flowing into the sector, this problem will get solved in the next 2-3 years significantly. So we have solved all the three key ingredients why these businesses should rapidly scale up now, according to Jack Ma. And if you look at one of the things that we should look at, as I said earlier in the presentation, is if you want to look at inspiration, for example, e-commerce market, don't look at US, look at China. And China clearly is at a very different scale in these industries. So that is what I've always alluded to. Look at China. That is the potential India has because of the structure of our markets. The other question that comes all about e-commerce is this discussion on super apps. And in India and everywhere in the world, everybody seems to be building super apps. Super apps have largely been a success in China, which has been entirely a closed loop system where limited competition has been allowed, and you have this big vertical behemoths emerge in the tech space, or in Southeast Asia. India has always been a very competitive e-commerce consumer tech market. And already we have specialists emerge across verticals, in different, whether food tech, ride sharing, e-commerce, payments, education. So it's possible that India it's going to be hard to build because of this nature, a super app in India. The platform that is most likely to have success in building a super app is actually WhatsApp, simply because that is how India communicates today with each other. We have deep engagement with WhatsApp. What are the benefits of a super app? It allows for significant cross-subsidization. Your customer acquisition cost incremental falls a lot. You bring in the strength of networks. It creates natural monopolies with high entry barriers, the strong network effects that come into play, and increases significantly the profitability as the market size, addressable market size for a super app expands and the lifetime value of the customer increases. So clearly, if anyone achieves super app, it will be a great outcome, but it looks quite challenging in how the Indian space has evolved in India. Now, talking about fintech, when you think of fintech, financial services can be broken into 4 broad categories. First is payments, lending, insurance, and savings, where we've already seen tremendous innovation on the fintech side in India, and where we are leader is clearly in the payment space. We have also seen good success in saving space, but I would say still we are early stages with discount brokers, and you have the online investment management platforms that have emerged. Still very early stage. We have 2, 3 very interesting plays in the insurance space, whether an aggregation platform or digital insurance companies that have emerged. The space that is still very underdeveloped and is always very hard to build is the lending side of the fintech space, where I would say we have practically not even started from a scale perspective. And the business models are very different in different aspects of fintech. Again, I wouldn't expand. The case for fintech is very clear. Just the customer experience on fintech is far superior to going to the traditional banking insurance channel. For example, even if you have to open a bank account, it takes a week, versus certain in some of the neo banks today, you can in 10 minutes seamlessly, without signing a document, you can open a bank account today. So and similar is experience of whether discount broking versus traditional broking. Every aspect fintech delivers a far superior experience, and they have been able to pass on those price benefits to the customers. So the case for fintech is much more easier to explain. If you look at the evolution of fintech space in India, in the first period, the first 15 years, is fundamentally about payments. There was one big exception, someone like Zerodha, which got set up. Then in the last few years, we have seen lending-based number of players emerge, and of course, neo insurance companies emerged, and other discount brokers emerged during the last 14 to 18 phase. This phase, the last few years, we are actually seeing enablers emerge. For example, someone like all the payment platforms or the crypto exchanges or the neo banks or the account aggregators. So you can clearly see a shift in the kind of players that are getting started and getting incubated in different parts of the fintech space currently. What are the kind of business models in fintech? So fintech fundamentally at a broad level has 3 kinds of business models. First is you make money on the stock or flow. For example, a broker makes money on transaction. An investment management platform may make money on the assets. That is, you make a fee on stock or flow. Then is the business where you make money on the net interest margin on underwriting the product, which is basically in lending products. And if you're writing insurance, you're making money of that way. The third model is you are neither making money on net interest margins or on the stock or the flow. You are actually a software provider, a solution provider, a SaaS or a PaaS platform. For example, platforms like Zeta or ClearTracks. But I want to make sure that these are not like that these platforms are one, all the models are a single way of making money. There is significant overlap where a number of fintechs have 2 kinds of business models, and some of them even have participate in all the 3 kinds of business models. So that is the interesting evolution that, so for example, a player like Paytm, operates in all the 3 stacks of monetization of business models in fintech space. So you always have to focus on how these platforms monetize their customers. Question is coming to lending, which is really the tremendous opportunity in financial services. The good part about digital lending is there's low friction. You don't have to sign documents. For example, BNPL, you can just click a button and your BNPL account is active. It's scalable. There's robust, tech stack. Fintechs can use your payment track record, your behavioral patterns, your cash flows to take better risk evaluation and better lending decisions. So the advantage for fintech is they can ensure higher repeat usage and lower operating and credit cost. There are the key advantages fintech has on the lending side. However, when you think about lending, disruption is not going to happen everywhere. See, you think about lending, you can look at them on two XYZ axis. One axis is basically how customers are sensitive to interest rate and how sensitive they are to availability of the product or the turnaround time. So where customers are very sensitive to the cost or interest rate, like housing loans, these are unlikely to get disrupted by fintech, less likely to get disrupted by fintech. And where the cost of funding matters, where the traditional banks and NBFCs have a strong competitive advantage. At the same time, on the other side is small consumer door loans or buy now, pay later, or personal loans, where the ticket sizes are smaller and the customers actually care about the turnaround times and are less sensitive to interest rates. This is the space where fintechs have clearly the largest opportunity to disrupt the market. And one of the biggest fintechs in India, which is not appreciated often, which has created fintech at an industrial scale, like Bajaj Finance, actually has operated in this space in the initial years, right? Their innovation has been on this part of the opportunity in the lending space. So finally, how does fintech win in lending businesses? One, you have to ensure lower credit cost by experience and using customer experience data and data analytics. To ensure low customer acquisition cost. Any good business is only good if your customer repeat. Cost of funding is always going to be a challenge for most fintechs. And you have to build capabilities on collection side, particularly if you're going on the larger ticket size and longer tenures. So that is the opportunity for fintech in lending businesses. Savings and investment, we've already seen some success, particularly huge success on the discount broking side by fintech. And clearly now more than 50% of the broking market is accounted by discount online brokers. And we are seeing in early stages at the new customer side, a lot of, again, disruption coming on the savings and investment products by new age fintech players. And we'll talk about in Q&A later in more detail with Vinay on this. And insurance, again, you have one successful online policy aggregation platform, which has about 90% market share. They've done a phenomenal job of, making insurance more accessible, cheaper, giving customer a lot of choice. And you've already seen the emergence of two more digital insurance companies like Acco and Digit. And they at the margin are creating competition to traditional insurance companies. But this is again a space, particularly parts of the insurance chain, where fintech has a large opportunity. And insurance fundamentally is understanding, data and understanding claim behavior and customer behavior. So clearly, fintechs have an advantage on the underwriting side of insurance and also on the distribution, where insurance industry tends to pay out a lot of money to access distribution. So clearly, fintech has the opportunity in distribution. So finally, what are the key challenges for whole the consumer tech and the fintech space? First of all, as it said, there are many Indias, right? So in the short term, there's always a risk that we may overestimate the size of the market. We may be right over the size of the market in a 10-year perspective, but on a 2-3 year basis, we may be overestimating how the market will evolve. So there's a risk of overestimating the market. Number two, because of the intense competition now that has emerged, a lot of fintechs has got funded and consumer tech companies have got funded. There's a risk that companies may overspend on acquiring customers, and then they may acquire customers who don't have do not have significant repeat rates. The cohort of customer quality is not great. And some of these companies may be too early in their spaces. And regulations are an ever-evolving space on consumer tech and fintech. And regulation, particularly on the fintech side, can be quite disruptive to the existing new age players. Now, moving on to the key question that emerges is how do we value all these consumer tech and fintech players? Before that, I want to get into a more philosophical discussion is what has happened in the last 100 years is that the value in the economy has started moving from tangible assets to intangible assets. 100 years ago, the value in the world lied in physical assets like real estate, factories, stores, and all. And then the value started moving towards brand, distribution, management, quality, innovation. And in the last 30 years, particularly, value has started moving towards ideas and intellect. If you today see some of the most highly valued companies, most of the, when you look at all the top 5 most highly valued companies in the world, they're fundamentally ideas. They're about intellect. So the value in the world has started shifting. However, traditional accounting frameworks don't capture the value that lies in intangible assets. Everybody knows, and many of you are business owners knows, that there is a value in having loyal customers. There's value of having brands, having value of having great talent and innovation. Yet these expenses, when you kind of invest to build these capabilities, they are charged out as expenses in your profit and loss. However, if you build a factory or a real estate, they are capitalized. So traditional accounting fails to understand the value often of intangible economy. And I'm a chartered accountant by education, so kind of understand the challenges there. So that is why when you look at the profit and loss, it gives you a wrong picture of what is happening in new age businesses. And this was best articulated by Jeff Bezos, the founder of Amazon. When forced to choose between optimizing the appearance of our GAAP accounting and maximizing the present value of future cash flows, we will take the latter. As investors, we are to focus on the present value of future cash flows and not on the traditional accounting metrics like profits and losses if we have to invest in businesses. So finally, how does the state of the consumer internet look like? If you think about internet companies, right, they are typically prioritizing growth over profitability. They are spending money to build a great custom tech stack, spending money on customer acquisition, building a great customer experience, right, and building a brand. All these are expenses in build. They don't have factories. They don't invest in office spaces. So these are the investments they make in the business, and they tend to go out in the profit and loss. So what happens is these companies, when they acquire a customer, the customer generates a gross profit for them, less their variable cost, but that is reinvested to acquire more customers and also to deliver a great experience. So because these companies are growing very rapidly, as of now, you see high customer acquisition cost and near-term, because of that near-term accounting losses. But as these businesses scale up and the customer acquisition cost goes down and growth goes down, while the pool of your existing customers become more important, you also start seeing accounting profitability. To think of fundamentally, these companies are currently in the stage of habit formation, and they are investing to create these habits. For example, for a lot of us today, food delivery has become a habit. For a lot of us, buying on e-commerce has now become a habit. We don't actually now need even the reason of discounts to use e-commerce or food delivery. So question then emerges is, how do you value these businesses? We believe fundamentally the valuation principles don't change for any kind of business. The tools, techniques, and lens through which you look at the business do change. So at White Oak, we use the 3 attributes to identify great business. One is superior returns on incremental capital. Number 2, scalable long-term opportunity. Number 3, strong execution and governance. And we use different metrics from traditional business to understand each of these attributes. For example, to understand the nature of the business, what are the unit economics? What is the nature of the sustainable competitive advantage in the business? Size of the market, what is the total addressable market? What is the monetization of that opportunity? If you're looking at execution, you want to look at how are the customer acquisition costs evolving? What are the customer engagement metrics? What is the quality of network? And what is the evolution of the network that is emerging? So these are the factors we should focus on when we look at. So the lenses, the tools that I'm using are changed, but the fundamental value principle to look at what we focus on to evaluate business does not change. So fundamentally, we are looking at recurring usage, looking at customer delight, whether these companies are building ecosystem and whether they are positive economics in the business or not. And to understand that, we are so finally, if you understand the efficacy of a business model, you want to understand what is the longevity of growth. when you look at the efficiency of the business model, we want to understand what is the expected lifetime value of a customer. Let's say if this customer buys with me 4 times in his lifetime, what is the expected lifetime value if I acquire this customer? What is the cost of acquiring the customer? And what is my present value of the lifetime value of the profits this customer will generate to me? That is basically expected lifetime value of a customer. CAC is cost of acquiring a customer. What is the churn rate? What is the rate at which customers go off from my platform? So effectively, you want to understand what is the LTV to CAC ratio. Any business which has any LTV to CAC ratio of 2 is good. Any business which has an LTV to CAC ratio of over 3 is a phenomenal business. And one of the consumer companies that currently publicly trades in the public markets has an LTV CAC ratio of more than 3. And it's an extraordinary business. I won't talk about the name, but it's very easy to guess what the company is. So finally, we want to understand the nature of the competitive advantage. Is it about scale? Is it about network effects? Is it about the brand or the tech? And there are a lot of metrics that we look at. What are the customer acquisition metrics, whether the traffic is coming organic or paid, where the traffic is coming from, what is the timeline of customer acquisition metrics. We also look at what are the user retention cohorts, what are the core customers doing, what is the revenue that has been retained, what are the best-in-class power customers in the space doing. We also like to understand the depth of the platform. For example, just giving example, food tech, what are the number of customers and how many restaurants and how many delivery partners are there. This is a 3-sided platform. You want to understand whether the depth of the platform is growing or decreasing. So you want to understand the lead times there, whether you actually generally want to have a platform where all the sides of a platform are fragmented. Then you as a platform owner have a lot of pricing power. So if none of your, for example, a platform like YouTube, right, where there are thousands of people, millions of people putting up their content and large thousands and thousands of advertisers, and then thousands and thousands of millions of users, there clearly the platform is completely fragmented. The more the fragmented the platform is, the more likely the platform owner can extract a lot of value. And finally, whether we want to see what is the competition, whether people use one platform or multi-platform. For example, in India, for messaging, most of us fundamentally use WhatsApp. So there is no multi-homing. While in a lot of other services, we might be using 2 or 3 services. And whether customers are loyal to the platform. We are unlikely to sign out of our WhatsApp account in India. It is so core to what we are. And finally, looking at the customer economics. So how do we look at customer economics and how does it matter? So I'm giving an example of 2 companies in consumer tech, right? One company, both the companies have same cost of acquisition, and both the customers are in the business for 4 years. So the annual churn rate is 25%. One platform has just higher frequency and higher ticket values in the platform, average transaction value, and gross margins are higher, while on the other platform, the margins are low. So in the first year, so 100 rupees is the cost of customer acquisition. In the first year, you generate a gross profit of 80 rupees through the customer, and that 80 rupees continues for 4 years. So the first year you lose minus 20 rupees on the customer, and the next 3 years you make 80. So fundamentally, you generate 320 rupees of gross revenue, gross profits versus a cost of acquisition of 100 rupees. So your gross LTV to CAC is 3.2, which makes it an extraordinary business. While here, because the customer has low frequency and lower order values, the gross margin is only 40 rupees. And because of that, the LTV gross CAC ratio is only 1.6 versus 3.2 here. And this is a mediocre business. So on one side is a great business, on one side is a mediocre business. That is why it's very important to understand the underlying customer economics. So finally, summarizing the whole presentation, and I think apologies, I've taken more time than I budgeted. One, the emerging internet economy is fundamentally changing how the customers and businesses interact with each other. For example, a company like Nike, which used to sell shoes earlier in their showrooms, today sells more than 30% of their sales on their website. That is how the world has changed. Number 2, you have a large number of digital native mobile first companies that are emerging, that are scaling at a rapid pace. They're building heterogeneous business models. So consumer tech and fintech space will create large winners and losers. As investors, we have to be able to identify which are the winners and which are the losers. Traditional technology-led business models will become an important part of the market in the next 5 to 10 years. So we can't, we have to understand this opportunity, and they are likely to disrupt some of the existing players in the public markets. The basic valuation principle does not change. The valuation of any business is the present value of future cash flows. We believe a lot of these businesses are in the early stage of habit formation, and that is why you're seeing accounting losses. Accounting losses are not equivalent to economic losses. What really matters is the long-term cash flow generation in the business, not near-term accounting losses. And at White Oak, we are focused on investing in the best-in-class consumer tech companies which dominate their industry, have positive unit economics, are participating in large and growing markets, and are run by credible management teams at the right price. I'll stop here and thank you for thank you for your time. And now we will open the floor for questions.
Thank you, Ramesh. That was very, very insightful presentation. I learned a lot today. Now, the first question, and there's a big queue that has got built up. So this is rather at a macro level. What investors want to know and understand is that there has been a massive startup boom in India, and it's happening across the world. But India has, of course, jumped places. Today, I think we are number 3 in the world, just behind US and China in terms of startup boom and the number of unicorns that we have created. Now, what are the fundamental factors why these startups are coming up, whether in India or in the Western world, and what are the factors which are driving this kind of a phase where so many new companies are getting incubated? Is it significantly driven by liquidity? And what happens when the liquidity dries up? Because there is a big burn rate for a lot of these companies for many, many years going forward. So how does liquidity play a role amongst other factors?
Sure. So first, I think the single biggest reason we're seeing large number of consumer tech and fintech unicorns and startups emerge this year is simply because of the pandemic. The digital adoption has been accelerated by 4 years. So logically, this should have happened over a 4-year period. But because of the pandemic and because of significant customer acceleration in a lot of categories, this is crunched into a 1-year period. So that is the single biggest reason. Like something was supposed to happen in 4 years is happening in 1 year. So we are all feeling this. But this big boom in consumer and fintech, what is happening to India is not new. When you look at it from a global perspective, it has happened in the US, it has happened in China a decade ago, and it has happened in Southeast Asia, it's happened in other parts of the world. So what we're seeing here is not new. It's new from an Indian context. From a global context, this is a pattern because internet platforms, the emergence of internet as a direct channel and the fact that emergence of mobile phone, emergence of the online payment ecosystem, and now the fact that there's a delivery ecosystem that has emerged. These and the fact that India has a median age of 29 with young people who are willing to much easier to use technology, and the fact that some of the traditional businesses don't do a great job of ensuring a lot of product availability in India, whether consumer companies or even fintech companies. The fact that penetration of financial services is abysmally low, considering the opportunity in the country. I think these platforms are solving a lot of multiple problems. So one, clearly, there's the opportunity side. The second angle is the fact that when you think of the global markets, right, already big leaders have emerged in some parts of the world. China market is close to non-Chinese companies practically on the consumer and fintech. India is the one market that is open to everyone in the world to invest in. So that's why you have companies, you have your American companies, your companies from Europe, Naspers from South Africa, you have the Russian companies, all types of tech companies have invested in India. So India is an open platform. We have Shopee from Southeast Asia, again, investing in India. So our market is open to every kind of tech company investor to invest in. And with 1.4 billion people, the scalable, we are actually one of the biggest, I would say, large untapped opportunity in a lot of consumer categories. And that's why globally capital is coming to. The question on liquidity and all, fundamentally, of course, because of the fact that what was supposed to happen in a 4-year period has happened in 1-year period, it looks like things are happening at an insane scale, at an insane pace. But it's because of the pandemic, and the opportunity has now become clear to everyone. For example, just look at the scaling up of some of the companies in India, whether Udaan or Misho, right? And how rapidly they have scaled up. They scaled up much faster than even the likes of Flipkart, Amazon in India. So you're clearly seeing the scale-ups are happening very rapidly. In terms of liquidity, see, you have to understand technology has the habit of creating large winners and losers. So will there be large value creation in technology space? The answer is yes. But will there be a large number of failures? The answer that is also true. Because that is and in some sectors we are in a land grab mode where a lot of ventures are getting funded. Finally, any industry, you only have to, at best, 2 to 3 big winners. So ultimately, these industries will consolidate over time. But as of now, we are in the fragmentation phase.
Very interesting. And I'll just take off from where you left. So we all know and read that it's a winners take all kind of a scenario as far as the tech space is concerned, all these platform companies and so on and so forth, which will eventually lead to a monopolistic kind of a scenario at some point in future. Now, when you are looking at multiple options for investing, how do you make those decisions? You're looking at 5-year, 10-year, 15-year periods, and the outcomes could be fairly binary, right? So how do you evaluate one versus the other? That's one. And second, how do you measure risk? Because it's a fairly risky bet when you have significantly binary outcomes.
Sure, great question. So one is while there will be, in certain spaces, there will be more binary outcomes. There'll be large part of the consumer tech ecosystem where, because of the large size of the market, there can be multiple winners. So it's not going to be 0 and 1. There'll be a few winners in certain spaces. For example, certain sectors, because of the scale of the sector, for example, globally, retailing, right? Or, it doesn't have one winner globally also. For example, even in US, right? You don't have, the share of the largest player is like less than 15% of the market. So you won't have winner take all in all categories. There are certain categories which are more prone to winner all take all, particularly categories which have deep network effects. So there are categories which have scale effects and categories which have very deep network effects. For example, something like a YouTube kind of a platform is likely to be a winner take all. But e-commerce, it is possible there are going to be horizontals, right? The likes of, when I mean horizontals, I mean players like Amazon, Flipkart and all, or JioMart. And then there are vertical specialists. For example, someone like Nykaa and different ecosystem, they're vertical players. And there can be winners in both categories, both sets of players, right? And because sometimes the verticals players are so focused on solving their category problems, they're far better suited to solve that category problems versus the horizontals. So even, for example, Nykaa can outcompete any of the horizontal platforms. This is not a stock recommendation, but I'm just giving you a business context, right? And as investors, we want to invest in companies which are leaders today. We are not in venture capital, Vinay. We are more on late stage investors in the new age ecosystem. So we want to invest in leaders, in their industries. The market should be large and growing. There's no point investing in a market which is small in India. Number 3, we want to see strong positive economics at work. What are the unit economics in the business? Which is fundamentally looking at LTV to CAC ratios. About 3 is a phenomenal business. We would like to invest in that. You also want to see credible management teams. There are management teams which are trying to raise capital and just burn capital. Others are very frugal in how they build businesses. And finally, you want to look at the valuations. So it's not in one answer. You have to get all these elements right. And in terms of risk, I think the biggest risk is if we get the unit economics of the business wrong, or the execution capabilities of the management wrong. In India, because a lot of these categories are at very early stages, the market is still out there for lot of these categories. So fundamentally, it's about understanding execution capabilities and the business, whether it will fundamentally allow you to make money over time. So those are the elements we focus on a lot. At the same time, we are kind of acknowledging the truth that there will be big winners and there will be failures in the industry. If we can, reduce the exposure to the big losers and have a more allocation to the big winners as a portfolio, we would do exceedingly well in these businesses. And that is what we are focused on.
Very insightful. Very insightful. So just going a step further in this direction and just looking at the payment tech space. There are a host of companies from PhonePe, Google Pay, Paytm, and many, many others. Now, companies where the predominant revenue model was coming out of payment systems, and suddenly UPI happens, where government introduces a platform which starts doing extremely well, and then it's free of charge. So what happens to the revenue model in this space for all the players? How do you think? Is there a possibility that a revenue stream could emerge out of this particular vertical going forward in few years' time, or do you believe that it's a dead end?
Yes. So the payment space in India has become extremely competitive. With the likes of Google Pay, PhonePe, Google Pay, Paytm, and a large number of other players, Amazon Pay and other players, right? And UPI, because of the UPI disruption and the fact that there is less profit revenue pool available in the industry, now it looks less likely that the payment itself will be a revenue pool, large revenue generator for these companies. So payments, platforms are basically large funnels for you to acquire a large number of customers. It's a funnel, but eventually a lot of these companies will make money by selling a lot of other products. For example, you are going to sell different products in financial services like investments, insurance, credit cards, even lending, right? So one on the financial services side, and of course, someone can also take a more broader horizontal approach where they can build in, travel ticketing, a lot of others convenience services built into the platform. So it looks like it's increasingly difficult to make money in the pure payment stack. There are, of course, business models within that. For example, someone like Razorpay or others, which are not on the consumer side of payments, but more are enabling businesses to go online or enable online payments. These businesses, if they're able, these businesses can create very large economic scale. They work on wafer thin margins, but because of the huge scale some of these players create, it is possible a value gets created on the B2B side of payments. And that is why you've seen the recent transaction of BillDesk, right? And you've seen success in US in Stripe and Square, and where they're payment enablers to businesses rather than to the consumers. There's an opportunity, but that is a very high scale business. You have to create extraordinary scale in those companies because those operate at very wafer thin margins.
Understood. Now, one thing which comes to mind is, and there are a few questions around that as well, that a lot of players in these segments are targeting retail segments, right? Ease of doing transaction and so on and so forth. And of course, scale is there. But moment you start looking at higher ticket, let's say a wealth tech kind of a platform, and in the previous answer, you mentioned that a lot of these people are looking at cross-selling and getting into other product lines where the primary payment tech revenue streams are drying up. But when you look at experience-driven, higher ticket product propositions, do you think these tech platforms can actually come in? Can there be a replacement of wealth businesses per se or wealth tech platforms going forward?
Yeah, so if you look at the wealth space, you can broadly look at and stack it into three categories. One is the entry level, customers, right? The first, typical portfolio values are like less than 2-3 crores, right? Very early stage. This is a space there when fintech is extraordinarily well positioned. Young people used to technology, more comfortable with technology, want simple solutions. Then you can consider the mid market, maybe let's say portfolio values of 2 crores to 10 crores, right? Which is where there will be an interplay between wealth management firms and the fintechs. And some of them who can execute well, the fintechs also can come into the space. And finally, we believe there is an ultra HNI category over 10 crores, very large size, which requires complex financial solutions, complex products. They also require a lot of other services which wealth management services provide. For example, succession planning, wills, all that stuff. They are more high touch customers. The ultra HNI segment is less likely to get disrupted by these platforms. Though across the board, there will be, in our opinion, pressure on fee levels, right? That because the fintechs are going to be aggressively going to price their products. So there is going to be pressure on fee levels, but it's unlikely the top end of the market gets disrupted because of fintech. But who knows? Someone in the fintech also extraordinarily innovates. But as of now, it looks like these are complex solutions, requires high touch selling, which the fintechs, that's not the fintech business model.
Interesting. The next question is something that you've spoken about in your presentation, and that's regarding how do you pick between two competing players? What are the factors, advantages, and differences that one creates over the other, which allows you to pick up one over the other? Where you spoke in terms of valuation about cost of acquisition versus lifetime value of the customers. Can you go a bit more deeper into this concept and also tell us there would be other things that you would be looking at when you are trying to choose where to invest when you're looking at competing set of businesses? What are the other things that you consider, and can you do a deeper dive into that, please?
Yeah, so when this question not only applies to consumer or fintech, it applies to just about every industry. How do you choose between multiple players, right? Because it's not just true for this industry. So fundamentally, you have to come back to the basics of investing, which is our approach is we like to invest in companies which are either leaders, dominant players in the industry, or gaining market share. So a typical company we invest in has to be gaining market share in the industry is operating because of superior execution. We like businesses which are building, instead of just insanely burning capital, are building sustainable economics in the business. See, if you start lending poorly, you can easily grow the book. It's very easy in any lending business, right? If you significantly discount your product, you can get sales. But are you getting a long-term valuable customer? That's the question to ask. And one of the most successful consumer tech platform companies we have emerged now in India, the name is obvious to everyone. They build a very sustainable business by solving a real problem. You have to understand what is the customer pain point in the category and how you are solving that problem. For example, I'm just giving example in insurance, something like the platform aggregators like Policy Bazaar, they add a lot of value to the customers because insurance is a complex product. And for normal customers, it's very difficult to do even what you call, compare prices and compare features of products. And a platform then like Policy Bazaar is also able to originate new products, right? From the data of the customers they have. Similarly, a platform like Nykaa, right, is able to, solve the problem, the fact that the large staples companies in India have only made limited product offerings in the beauty and personal care space. And particularly in the tier 2 and tier 3 cities, these products are not even available. The problem is probably solved a slight bit in metropolitan cities. And that's why for a platform like Nykaa, 60 to 70% of the revenue comes from tier 2 and tier 3 cities. So you want to see whether they're genuinely solving the problem or just giving you something cheaper. Because if you're offering me something cheaper and I'm buying the product, next time somebody else offers me another cheaper product, I might shift my loyalties. So are you creating a valuable customer? Fundamentally, the business about that. And then you want to look at how the management DNA towards it. the organization culture is. You obviously want to see management teams that are stable. You have low attrition. You have seen that same set of, the management team is strong and you have low attrition in the teams. If you're an organization where there's huge management attrition, then you're not sure what has been built in the past. The same team is around there to build the future also, right? So it's fundamentally going to the basics of whether you're solving a genuine problem. Are you creating positive unit economics? Are you emerging leader because you're offering a better product, or are you becoming emerging a leader simply because you're discounting aggressively in the market? Ultimately, discounts are not sustainable, but better products are sustainable. Better customer experiences are sustainable. At White Oak, we all tried the products of all the consumer companies, whether in the public markets or private markets. We just download all the apps, read the reviews of the apps, see what customers are saying. For example, even if you just go to Android store, right, and look at the ratings, Android app ratings of different consumer companies, you can see the difference, that which company has a 4.6 plus 4.5 rating and which company has a 3.5 or below 4 rating. That tells you how the customers are perceiving these platforms. You also want to look at the quality of customers, whether you have creating customers who are loyal long term. So it's all going back to the basics rather than figuring out. There is no rocket science to the answer. It's just like we look at all traditional businesses also from the same framework, right? Are you creating a sustainable competitive advantage based on superior execution? And then we would like to buy the right price, even if it's a great business. But if the price is not right, at White Oak, we will wait for the pricing to emerge favorable. And often markets provide you that opportunity.
Very interesting. We are completely out of time. Maybe just one last question, Ramesh. And a lot of people are asking around this, and you've touched upon this in your answer just now. It's regarding the customer acquisition and your primary valuation and stock picking investment methodology driven around the value to customer and the long-term value that numerically it can generate. Aren't you carrying too much of risk on this, especially when you look at customers could be highly movable, so to speak, right? It's a very fragile segment. I mean, people could move from one particular platform to the other fairly easily. And when you're investing with a 5, 7, 8-year horizon, you're looking at cash burn rates which are significant in the immediate period. Don't you think that the risk becomes too high, or how do you manage that?
Yeah, so that's a great question. First of all, you asked a question on customer behavior. So we act very closely look at customer behavior. So we ask for data of customer retention rates and what is the rupee retention rate. The same customer in year one, how much revenue generates. Let's say we acquired customers in 2017. What are the same pool of customers, what kind of revenue they generated in 2018, 19, 20, and 21. So you want to see in every year how the customer cohorts are doing well. For platforms which are doing well, right, these customer retention rates are going up over time, right? For platforms that don't have a good competitive advantage, the customer retention rates go down over time. So you ask for this data and you understand this behavior. You also want to understand where the stage of the industry is. Some industries are very fragmented and leaders have not emerged. Other industries have consolidated because they've gone through a phase of fragmentation and now leaders have emerged. Now for new players to come in, they have to actually put tons of capital on the ground. And even then the probability of winning is not large. So you want to see, that's why I said we want to focus where industries, where leaders have emerged. See, we are not in early stage on venture capital. Right? We are not venture capital investors. We are fundamentally more on the public market side. We do invest in pre-IPO investments, companies going before public. So we are more focused on companies where leaders have emerged. And now for a new player to come and disrupt that space is increasingly getting difficult. And you want to see the customer behavior in that platform. And remember, just because some product is discounted does not mean people will, what do you call, go away from the product. I was yesterday reading a study on ride hailing cabs in the US market. When ride hailing cabs have raised prices, and we have seen last 6 months in Ola, Uber in India also, right? A large, good part of the customer pool hasn't gone away from them, despite the fact that today they're a lot more expensive than the traditional options of like taxis and all. That means these platforms have pricing power, right? And there's a set of customers who are willing to pay for that customer experience. And there are a set of customers who just came because it was cheaper. There's a set of customers who came to these platforms because this was cheaper than the taxi, right? You got an air-conditioned, nice car versus the not so great experience in a black cab, right? But there are customers who want to pay for the experience, and they're willing to pay a significant premium over the black cabs for using these platforms. So you want to understand whether these platforms have pricing power or not. And that happens when prices go up, and you see whether these platforms lose customers or they retain customers. So we have data now from US, because US has already seen a round of price hikes in the space. And you're seeing that the customer base has not fallen significantly. You know, the best customers continue to use them. So every space you have to understand the customer behavior. And that's how you're going to, and you're right about, Vinay, about the risk. But every risk is an opportunity. We are all also significantly underestimating the growth. If you ask about every company, right, what are we wrong about? We are wrong about the growth. You know, we are all modeling 25, 30% growth. And these companies are growing at 50, 70, 80% growth. So when you think about the risk, you should also think of the opportunities you miss in the process, right? Because this is the future, right? And you know, at the end of the day, the value of every business is the present value of future. So you have to own businesses which will create value in the future, not businesses which have just created value in the past, but don't have a future. So you have to also consider risk that you may miss out on a lot of opportunities in the process. Risk is just one side
Wonderful.
of it.
Wonderful, wonderful. That's a very, very balanced view. Fantastic 1 hour session with you, Ramesh. I think all of our investors have learned a lot of new insights. Thank you so much for your time. And a good day to all of you. And let's move on with our rest of the corporate meetings for the day. Thank you.
Thank you, Vinay, Edelweiss, and all the participants for attending the session.